All right, I'm going to go ahead and get started here for those of you who are on time and want to respect you guys' time tonight. But anyway, thanks for coming and checking in. This is the just a crash course on infinite banking and how it relates to real estate investing. My name is Jason Powers. I partnered with the National Real Estate Investor Association last year, and I'm kind of their partner for all things life insurance and infinite banking related. And so it's been exciting over this past year, just being able to teach around the country and teach at different REIAs and do webinars and different programs. So I'm just thrilled every time I get on here and teach more people about infinite banking, especially real estate investors, because that's what I've done through the past 10 years or so as well. And so it's kind of always been a passion just to mix the two together. So hey, through this, I'm going to keep it at about 30-45 minutes, real simple and real high level. Through this, if you have any questions, feel free to drop them in the chat. I will give a few minutes towards the end for Q&A, so feel free to drop. We can talk then too. But you can drop your questions in there. I'll try to answer them along the way. Drop in the chat if you're on. Where are you calling in from? What state you calling in from? I'm out here in almost sunny Colorado. We finally got some weather clearing out. I think the whole country was frozen over there for a couple days, but yeah, I'm out in Colorado, New York. It's good, and so anyway, yeah, Miami, Florida. Yeah, it's nice. I heard it was extra cold down there lately, like 40 or something. Is that extra cold down there? But that's nice. A lot of us were talking about flocking down to Florida this past week. So good. Hey, anyway, let's get started. The infinite banking concepts. Let's get all my stuff here. All right. Hey, Nelson Nash once said, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of the money would be back under control of 3% of the people. Well, why is that? Well, it's because they understand money and how to get it to flow to and towards them instead of away from them. And that's kind of what we're talking about tonight as we dig into this is obviously money and what are we trying to do with real estate? Where are we parking our money? What do we want to accomplish? Why are we doing what we're doing? So let me ask you a question. What keeps you up at night? You don't have to answer that, but feel free to answer it in the chat if you want. But what keeps you up at night? There was this interesting poll done a while ago that I ran across. And of course, to no surprise, the number one cause that keeps people up at night was money-related worries. 58% of Americans feel that finances control their life. 77% are anxious about their financial situation. 52% have difficulty actually controlling those worries. And retirement being the chief related money worry, which isn't too surprising, especially with the ebb and flow of what we're doing with our money in markets and qualified accounts, and they're rocking all over the place, especially during COVID, and we just don't know what tomorrow holds. So, but what I thought was interesting was this part of the graph here that talked about when stressed, people are less likely to do things like save, plan their spending, even something simple like make a shopping list, which is planning, and plan ahead to cover unexpected costs. But thinking about long-term goals, even for a few seconds, can help reverse the negative impact of stress. I thought that was kind of interesting because how much money affects other things we do, other choices we make, and how much it detracts, like deters us from making wise decisions, and even in other things, and it spills over. So I thought that was pretty interesting. So I want to talk about a couple human behaviors before we dive into this. There is something called the arrival syndrome. Anybody ever heard of it? Basically, it says we already know all there is to know. I have arrived. I laugh every time I have my navigation on in the car, and when I come up to the destination, it stops and it says you have arrived. And like so every time I hear it, I chuckle and I think of this. But we already know all there is to know. Nelson Nash again, and I'll talk about Nash quite a bit throughout this and talk about a book you should buy and read near the end. But he says when this arrival syndrome infects us, we stop growing, we stop learning, we rot, we turn off, and we tune out the ability to receive inspiration because we already know all there is to know. And so I would just encourage you tonight as we go through this just to be open-minded about it. What I'm going to show you, it is unconventional, but it is not gimmicky. It's not, it's not, oh, we're the only people that know it. And it is just something that's not taught in public common circles. We're taught traditional things to do with our money. Okay, so keep that in mind as we go through the night. So if you understand what's really happening, you'll know what to do. The second human behavior I like, it's called Parkinson's law. It's work expands to meet the time envelope allowed. It's got three parts. So work expands to meet the time envelope allowed. Basically, that's saying, hey, okay, we're in real estate. If you hire a contractor to remodel the bathroom and you say you've got a week to do it, he's going to do it. It's going to take up a week to do it. And you get to the next project, hire same contractor, same size bathroom, and tell them, you know what, we have a month. You have a month to do it. How long is he going to take? He's going to take a month to do it, even though you know he can do it in a week. And that's what we do that in our own life. Like work expands to meet the time envelope allowed. Second part of it is a luxury once enjoyed becomes a necessity. So a good example might be, think of how many of us, once you got that first air conditioned car, if you ever had to drive one without one, but if once you got that AC in that car, you'll never go back. You're never going to go buy another car without AC. I was talking to someone yesterday and she made the comment about, she's like, oh, I love my remote start in my car. I will never get a car without that again. And it's just that a luxury once enjoyed becomes a necessity. So what do we do in our life? So expenses rise equal to income. As our income goes up, expenses rise. We go, okay, well, we can afford more of whatever. And so that's this Parkinson's law, just a combination of that. Basically, if this is something that we can overcome, if this is something we can control and get a handle on in our life, we will win in the end. But we have to get our head wrapped around, do we need to take all the time we're given, even though we could do it in shorter? Do we need to have this luxury or that luxury, even though we could sacrifice for a little bit just to get ahead? And do we need to rise our expenses as soon as our income goes up, and so forth? We have to change the way we think. I say it all the time. Change the way you think about your finances and it will change your life. Okay. There's three types of people. Okay. There's the debtor. Let's think of a car again. You're going to finance a car. You're going to pay it off over time. You go into debt. You pay it off. Let me just get over here. You pay it off over time, and then you get back to zero. Finance another car, pay it off over time, get back to zero. Okay. And then we do this throughout our life and we reset every time we do it. Okay, then there's the saver who does the opposite, says, I'm not going to go into debt over this. I'm going to save up for it. And then start over, and I'm going to save up for that next vehicle and start over and save up for the next, and so on and so forth. We do this throughout our life. What I want to teach you is how to become what we call the wealth creator. And that is how you can create this financial velocity that can literally last for generations. Okay, and the vehicle through which I'm going to show you how to do this is called the Infinite Banking Concept. This is a book on the screen called Becoming Your Own Banker by Nelson Nash. I have it on my shelf back here. I read it annually. I eat, breathe, and sleep this. I practice what I preach. I'm doing it myself, and I got into it as a career after I was already doing it because I loved it so much. And so this book, I'm going to give you a link to be able to buy it and a discount at the end here, but I'm not here to sell you a book, but it's a good read, and I think it will just bring it together for you. IBC, what is it? It is not just some financial hack. It's about taking control of the banking function in your life. Think of everything we do with our money. How much do we rely on banks in all that we do? We finance everything we do in life. We finance our cars, our homes, even in real estate investing. We're looking for short-term, long-term, and we finance it, right? We like the hard money lenders and the private money lenders, and then we use our credit cards and we finance everything. And this is about taking control of that banking function in your life and building up a banking system of your own. So it's the best place to warehouse your wealth. That has guarantees, it has safety, while providing ready access to your money, allows you to take over the banking function in your life. Okay. So again, this is high level. I'm going to go real fast through it and just show you what it is. The vehicle through which we teach people how to do this is a properly structured, dividend-paying whole life insurance from a mutual carrier. Now, before you have an assumption on whole life, let me explain what it is. I break this down. I get wordy about it. I always joke. I say, we'll say that 10 times fast. I get wordy about it because I'm particular about it. It is not your grandparents' old life insurance policy. It is structured different. It is not the life insurance policy that certain financial gurus today rail against. It is structured different. Okay, it is properly structured, a particular way to maximize cash value growth inside of your policy that you can use now, not later. Dividend paying from a mutual carrier. I say that because there are two types of insurance companies. There are stock-owned companies, its interests are for the stockholders, and then there's mutual carriers. Its interests are for the policy owners. As a policy owner, you're effectively one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So that's why I say dividend paying from a mutual carrier. Don't just go out and grab some life insurance. It's not going to work. And in this context of this conversation tonight, I'm talking strictly whole life insurance. I'm not talking term. I'm not talking index universal life, variable universal life, and so forth. Okay, I'm talking specifically whole life insurance tonight. Okay, what are some benefits? Why this? Okay, as we talk through this, one of the first things I want to always talk about is we always have to think about how we change the flow of our money. So if we are repositioning ourselves to control the banking function, if we are repositioning ourselves to be the bank and loan ourselves money, be able to loan others money even, we have to start thinking differently about our money, change the flow of our money. Don't just think of, as I explain this, don't just think of okay, well, I don't have much extra money. I can never do something like this. Sometimes that's not the right perspective. Sometimes it's about how do we change the flow of existing money to recapture debt even and get you ahead that way. We'll talk more about that. Okay, I think the single greatest benefit is the fact that the cash value inside your whole life policy, which I'll break down, grows uninterrupted even while you're using it. What that means is, let's say if I've got a money market account and I've got 100,000 sitting in there and it's making 5% right now. If I pull 50 out and use it for something else, there's 50 left growing at 5%. If I have some qualified account making money at whatever rate and I pull money out to use it, it's only growing on what I left in there. Does that make sense? So I'm interrupting the growth. Inside a policy, when you borrow against the cash value of your policy, the whole amount is growing as if it never left. So let me say it again. When you borrow cash against your policy, it's growing inside your policy as if the money never left. And there is just simply not another vehicle out there that does that. Okay. It addresses this lost opportunity cost for most of us. I'm not going to camp there. Income tax-free growth. There is a point in your policy where your cash value is more than your outlay. And I'll show you an example, but the gains, so to speak, inside of your policy are income tax-free because you will always access them as loans, never as income, and the IRS does not tax on loans. Okay. It's not it's not trying to skirt around it. It's perfectly legal. They've been doing it for 100, 200 years, almost. So it's a vehicle through which you can use it now throughout your entire life. Replace the banking system, be your own bank, and you can even use it to supplement retirement later. Furthermore, you can use it to supplement retirement income tax-free. It is safe from investment booms and busts. It is not an investment product. It is an asset. So this is not tied to markets. So during COVID, when markets were tanking, 2008, when things were tanking, people who had cash value whole life insurance, they were not stressing about the value of their policies. There's a guaranteed growth component inside of your policies, and they cannot be deterred. It is not related to investments, what the markets are doing. When you take loans against your policy, they're not tied to your credit. You, the carrier, probably me, because you told me you needed to get a loan. We know about it, and that's it. Furthermore, they're unstructured loans. When you borrow against your policy, it's an unstructured loan. You get to dictate the loan terms. You get to dictate, am I going to pay? How much am I going to pay? Over what time period? How long am I going to take? If I borrow $50,000 from my policy, I decide. I'm going to take I'm gonna pay myself X amount over X amount of months and pay it back, or I'm not going to pay it at all for the first year or 2 years or 3 years, whatever. It's up to you. Okay, it's a multitasking dollar. I've alluded to it earlier. It is something through which it's growing inside the policy, and then you're borrowing against that money, and you make that money make you money or save you money. So you got money growing it to make, it's making money out here in the real estate world in this context, and then it's also growing inside your policy. So it's just this multitasking dollar. And of course, we're dealing with life insurance. So you have this generational wealth transfer, which is my favorite part of the whole thing, actually. Okay. So who uses it? Well, interestingly, if you start poking around, you start finding, oh, banks. Banks, of all people, carry billions of dollars in cash value whole life insurance. Billions. Bank of America, 20 billion. If you look at their balance sheets, which you can find online, it's a tier one asset. And you'll see how much they own. Big companies, they understand it, they utilize it. As you start poking around, you start finding different stories on people who've used it and how companies are using it, how business owners are using it. There's a fun story about Walt Disney. He couldn't get enough of a loan to finish building a theme park based on a mouse out in California. And so you know what he did? He borrowed against his a whole life insurance policy to help finish funding it. Ray Kroc, when he bought out the McDonald brothers, he borrowed against two of his whole life insurance policies to pay some key employees, and then with the other, he started a marketing campaign on his newest, latest, and greatest mascot. Any guesses? Mr. Ronald McDonald, right? And so it's just kind of interesting as you start digging around, you start seeing who's using it. Certain dignitaries, they knew about it, they know about it, and it's interesting. So there was an article put out, and I meant to put it on here. When President Biden had to disclose his finances, talked about how he owns 0 investment products and 6 whole life policies. And then when you see stuff like that, you start scratching your head. You go, wait a minute. Now he's probably not broke. Why didn't he put any money in? Why does he have 6 whole life policies and no investment products? His wife owns some, but still, point remains. What do they know? Why can't we do it? Well, we can. Okay. So I love this quote because you've got to be very careful if you don't know where you're going because you might not get there. So we have to understand kind of what are we trying to accomplish in the end. So I'm going to talk real quick about 5 rules of IBC. We're going to get into a quick case study, and then we'll start wrapping it up for you for questions and stuff. 5 rules of IBC. I want you to get that book, and I want you to read the book if you haven't read the book. It explains this in a lot more detail. Take the long view. Real estate investors, we're a conundrum. We have this ability to think long range when it comes to buy and hold properties, whether it's residential, commercial, whatever. You're thinking long range. You're thinking down the road. What's it going to do for you later? Yes, it's going to make you some passive income now, but your end game is usually stacking that passive income so that you have passive income and don't have to truly work anymore later. So we have this ability to take the long view, but on the flip side, we are some of the most impatient people that I know because real estate deals, we're always like, we got to get the deal done now. We got to get it done yesterday. We got to get it done yesterday. Let's close this thing. Let's hurry up and finish this thing. And so it's funny seeing both sides of it, almost in the same sentence all the time. But with infinite banking, you have to take the long view. You got to think long range. Don't be afraid to capitalize. You'll understand. The more you understand it, the more you see, the more money you put in, the more that's compounding over time. The more it's compounding, the more it's growing, the more you have to use throughout your life. There's this phrase we say, don't steal the peas. Basically, that means it's a reference in the book, and it means be an honest banker. If you're gonna be your own bank, in effect, be an honest banker. You would not steal from the bank, so don't steal from yourself. Don't not pay yourself back. As tempting as it is, don't not pay yourself back when you borrow, because you can recapture that money every time. Every time you get that money back, you're using it for something else. And the growth inside that policy is growing, so you can use that money as well. So don't steal the peas. Don't do business with banks. Hey, if you can be your own bank, great. And then you've got to rethink your thinking, which I've alluded to. We've got to change the way we think about our finances, how the flow of our money works, and start understanding how we can control that banking function in our life. Okay, I'm going to pause there real quick. Let's dive into a case study. I've been bulldozing through this. Feel free to put any questions in the chat if you want. Right now, I will put time after I give you one big example here, just so you can see it play out for one person. We'll have time for Q&A as well. All right, let's go. This is a client of mine, and his objective was he had rental properties, some residential rental properties, and he also had a day job. So he didn't need that income right now. So his approach was, as passive income would stack up and he'd have enough, he'd buy another house. Because he was just stacking properties. He had 18 of them by the time we talked. And stacking properties, and was just going to keep doing it. And then he heard about IBC. And so the discussion became, what if instead of him getting that free cash flow and putting it in a bank account and letting it sit there until he has enough for a new property, what if we put it through a policy first? So we changed the flow of the money. You understand? We went from earnings to policy. And then as the policy builds up and there's enough, he's going to pull it out and buy a property with it. Now he lives in small town Midwest. He could get properties pretty cheap out there. It was a little college town, and he's still doing it. So anyway, so here we go. Everybody's situation is different, so I don't want you to get hung up on the number of zeros on this example. We could take 1 0 off, add 3 to it. We're going to find out what is appropriate for you and your situation, and so we'll sit down, we'll talk through your situation, what makes sense for you. Sometimes people start small, some people start big. I've got clients doing $200 a month. I've got a client doing $300,000 a year and everything in between. So we'll find out what's appropriate for you. For him, we started a policy. He was going to pay $36,000 a year. That was free cash flow. He didn't need that money anyway. It was sitting there. Okay, in his case. However, so when we start a policy, there's a few things going on here. I'm not going to break this down in too much detail, but he put 36,000 in year one. He could get about 23,000 out. You see the red box here. So he put 36 in, he could get about 23 out. And then so on and so forth. So way over here on the right, you'll see the death benefit growing because it's life insurance. And then over here, there's the dividend column, which I want you to pay a little bit attention to, but you'll see those dividends compounding year over year over year. Remember, we said dividend paying whole life insurance. And we're having these dividends buy more insurance, which in turn is giving you more cash value. It's compounding your cash value growth on top of your premiums. Now for him, he's only going to do this 36 for 10 years, and then we're going to restructure it a little bit, and he's going to drop it down to 12 a year because he's pushing for retirement, so he doesn't want to keep chucking 36 in. He can, but we're not going to, I think, in his case. So built out a spreadsheet for him. I want to break down this spreadsheet just so you can see how it works. Okay, it's a ton of numbers. Don't be scared. All right, so talking about that first year where he put 36 in way over here. I'm gonna get the pen here and see if I can do this. All right. Okay, so you see over here net cash value where the arrow is. And then this is his premium column, okay, up here at the top. The premiums he's paying. And then his where are we? His cash value, sorry, right here. So that's his cash value. That's the premiums he's paying, okay. Now, year one, there's not enough in here for him to pull out and buy a house. So year one, he's not going to do anything with this policy. He's going to let it sit there. He's going to grow just like he would have in his bank account. Second year, he's going to pay premiums again, but now he's got about 56 in there available. So now he's going to borrow 50 out and buy a little 1 or 2 bedroom house there in the college town. And so he took the 50 out. So that's what this second number is where the arrow is. And now he's going to set himself up with a repayment plan via rents So rent, instead of paying a mortgage to the bank, rent's going to pay himself back. Now he's going to set up an initial 4% 20-year loan. That's $303 a month, and rent is going to pay that. So that's how over a 20-year period he will recapture that initial 50,000. Okay. But he's not changing course. He's still paying premiums on the left side there. So fast forward, that's the first year. The second year, that was the second year, sorry. By the third year, not quite enough in there. You see in here, he's built up 39,000. He paid premium because he borrowed. And he built up 39, so he's not going to do anything this second year. Then the next year, he's got enough in there, so he's going to borrow 50 again and buy that second house. He's going to set himself up with another same loan, and we just picked 4% 20. He could get down the road and be like, okay, I want to do 5%, 10-year, whatever makes sense for him that year, for rental income and such. So for this same type of loan, so that's why his payments doubled. You'll see this column here is his loan repayments back into the policy. And so you see now it's gone from 303 to 606. Well, a year later, he paid the premiums again. Remember, he's paying premiums, but he paid 36 in, but his cash value grew more. And now he's got 50 in accessible again, just a year later. And so he's going to borrow, buy another house, set up a third payment with himself. So that's why he jumps over here from 606 to 909. And he's going to keep doing this. This is year 6. He's going to do it again. Year 7, he's going to do it again. Year 8, he's going to do it again. And each time you see same payments. So his payments are jumping each time. And he's borrowing from himself each time. And he's recapturing this money over the years. All the way through, I got year 10. He did it again. Now, for illustration's sake for him, we stopped after 10 years just to see what would happen. We could have kept going, but we stopped. So this was the last year we borrowed on this example. Now he's up to $2,700 a month in repayments back to the policy. And over here on the far right, you see his cash value jumping by $2,700 a month, plus extra jumps on policy years. But now, 10 years in, year 11, remember, we dropped his premium payments, which I talked about earlier. So he only put 12,000 in year 11. And his cash value is growing, 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 growing. Let's fast forward a little bit. I'm going to take you down to year 17. He's still paying these 12,000 a year premiums. See if I can undo that. 12,000 a year premiums. But look at the math. Because of compounding, look what's happened. He paid 12,000 a year. He paid 12,000 this year in premiums. His cash value grew 36,000, give or take, that year. Not only that, he recaptured a year's worth of loan repayments. So he had a total cash value growth, if you will, of 52K that 1 year. Because the policy itself is compounding. And so he put 12 in, the cash value grew 36,000. Plus he recaptured almost another 20,000 in loan repayments. So he's got a whole nother additional 52,000 that year in cash value to utilize however he wants to. But he's already got, you see 16 years in, he's got 300,000 in cash value sitting here that he can use for whatever he wants. He can go out and buy more houses, if he wants to. And again, it's unstructured loans. You decide what you're going to do with that loan. And you decide how you're going to pay it back. Okay. So for him, by age 67, he's got over $500,000 in cash value sitting there. He's still paying it back. And he will continue to via the rents. And just a side thought there. Remember during COVID, Nobody could pay rent anymore. Mortgages were caving in like nobody's business. And now, if you're the bank with an unstructured loan and rents stop coming in, how affected are you? Minimal, minimal, unless you're living off of free cash flow, of course. But you don't have a bank breathing down your neck saying, too bad, tough cookies, man. You still need to pay us. We're going to foreclose on you. And just to have that freedom alone, for me is worth it. So anyway, so for him, at age 67, he's got a gross 660,000 in cash value, but 500 because he's got loans out. It's 524. 662 is his gross. 524. So if he paid all of the outstanding loan back, he'd have 662,000 sitting in there. That's what that means. Okay, that's one example of what one guy is doing with one policy. And we talk about setting up your own privatized family banking systems. And when I say systems, that's why you see people, myself included, as you can, you start more policies throughout your life. And the more you're stacking policies, now you've got this system of policies going on, you know, and then you're getting them on your spouse, and then you're getting them on your kids, you know. I've got policies on my kids as well. I've got a few policies on me, and theirs is, they're young, they're 7 and 8, and I've got it set up for them so that by the time they're 16, we can borrow. I'll teach them. We can borrow and buy a car. And then we'll pay that back between there and college. And then by the time they're in college, we can borrow and pay for a year of college at least with it. Who knows what college, if they decide. But if they don't want to go to college, I haven't locked up my money in some college account, and then got to figure out what to do with that. It's in the life insurance so that I can decide what to do with it outside of that if things change. So I always tell people all the time, I hear it all the time. I'm going to do this one day. I'm going to get around to it. I'm going to get around to it. I'm going to get around to it. I'm telling you, get around to it. We talk about when is the second best time to plant a tree. It's like if we didn't do it today, people are like, I should have done this 10 years ago. I should have done this 5 years ago, 20 years ago. When's the second best time to plant a tree? It's today. It's today. Okay. If you guys have time, I'm going to do one more. I'm going to change it, take you out of real estate for a minute, and just take you through a debt recapturing strategy. And this is a situation where this client of mine, he had $109,000 in bad debt. Okay, he was on a 30-year plan to pay it off. We sat and did all the math. We drew it out. We needed to change the flow of his money, and we did. And if he sticks to it, he's still going through it. If he sticks to it, he will be 9 years debt-free and have $95,000 in cash value to show for it. Okay. A sorcery. I was like, I joke with him. I'm like, what is this sorcery? And so let me show you how it works. Okay, these were his numbers. All right. I'm going to zoom in on these in a sec. But he had credit cards, lines of credit, and school debt, just bad debt, stacked up on him. And he was just like at a loss. Like, how am I going to do this? And it's going to take me 30 years to pay this stuff off. Short of having just some major increase in income or winning the lotto or, stuff like this. But you don't want to bank on. You want to have a good plan in place. Okay. All right. So he also had an emergency fund. He had $25,000 sitting in a savings account. He understood if I took that 25 and just paid down my debt by 25, now I have no savings and I still have a boatload of debt. And so he didn't want to do that, which I think was the right move. And so we talked about what happens if, and we drew this out and we talked through it quite a bit. And we said, what happens if we change the flow of the money? What happens if we take that savings and kickstart a policy with it, but then start using that policy to recapture your debt? So let me explain. So we did. In the end, it made sense. So we kickstarted a policy, 20,000 a year, and then he was going to start borrowing cash value from it. But it was easy to figure out how is he going to come up with the first year's of premium because he had it in savings. The real hurdle was how do we keep paying premiums ongoing for him? And so what we did was we looked at all this debt And look at here at the top. This is the second line here. This is the monthly payments he's making. Well, this first one, he's dropping $12.87 a month on this debt. And that's a lot of money to be going towards debt. And so we said, why don't we try to free this one up first? And so we did. So we started his policy. We then borrowed all the cash value out of his policy, which was over here. And we wiped out this first debt all of a sudden. And now he has an extra $12.87 a month. So remember, to overcome Parkinson's law, it was, let's not take that $12.87 a month and just go spend it. It just means we can go, oh, now we can go do something else with it. In his case, we said, hey, let's take this $12.87 a month. Let's put it over here. I didn't put it on here, but let's start setting it aside in a bank account. And that's how we're going to pay future premiums. So now we freed up money that was going to bad debt and we're putting it towards a good cash value growth policy. Okay. So, and someone just commented that it might take too long to be able to use the money. And so I would comment that the way we structure these, remember, the cash value is immediately accessible as soon as it's funded, right? But if we're paying monthly, I'm annualizing these examples. Some people pay monthly. So even if we build it certain ways where if you're paying monthly, you can actually borrow against your policy monthly. So I wouldn't necessarily write that off. I'd say we get on a call and talk through it and see what that looks like, what your needs are, and structure something based around that. But okay, so now we've taken this, and now he's got a way to fund future premiums. So this $12.87 a month is going to continue every month going into a side savings account, and when premiums are due each year, he'll take from there and pay the premiums. Okay, and we are also, and then so the rest of the year he continues paying these monthly premiums as scheduled. All right, that first year. Year 2 hits. He paid the premiums. He had cash value. We took it and we wiped out the next 2 debts with it. Okay. Now he's freed up 161 and 73 a month. So here we're implementing now, it's called snowballing, if you've never heard of it. Basically, we're just snowballing our payments to accelerate other payments. So you see we went from 161 and 73 and the 101, and that equals 335 a month. So that's why his monthly payment here jumped from 101 to 335. So now we're going to snowball these payments to try to accelerate paying this stuff down as we go. All the while, he's over here with this, saving and paying premiums, okay? And each year, we're going to borrow. So year 3, he did it again. Paid, borrow, wipe out the next 2. And then we're going to snowball these payments. Now he's up to 591. And then beginning of year 4, did remember he's over here saving, paid premiums, boom, wiped out this next one and paid this one down further. He couldn't quite get it paid off. But we're snowballing, so we took this 591 and 202, 201, and that's 792 a month. By the beginning of year 5, he had borrowed and wiped out that final debt. So now, by the beginning of year 5, he is outside debt-free. But let's be honest, we've been borrowing against our policy, so now we've been racking up a policy loan. But we've been paying our outside debt down as we go. But in just 5 years, he's outside debt-free. Remember, your policy loans, they don't show up on your credit. So now his credit's going to start going up. Now, hopefully he won't just go out and get some more loans, but so now his situation is starting to turn. But now let's turn our eyes on the policy loan that has been built up over that 5 years. Now he's built up $65,000 policy loan. Remember, we just paid off that final debt that was $792 a month. So we're going to take that same $792 a month and begin paying the policy loan back. All the while, remember, he's over here saving and paying premiums. However, remember my first example, after 10 years in his case, we reduced premiums. In this case, after 5 years, we're reducing premiums. So we've got enough momentum going and growth going inside the policy. We're actually dropping what's called the PUA portion of the policy. That's saving him $11,500 a year that he's now not spending on PUAs, or $959 a month. But we're going to take that $959, add it to the $792, and jump that loan repayment. So that's why the loan repayment now jumps. And so he's recapturing that money even faster. Let me say it again. So that final payment he was doing from his loans was $792 a month. That's what he's using to pay the policy loan back now. Year 6, we restructure the policy. The savings of that restructure we're using to also add to the loan repayment. So all of this we are accomplishing without any extra money. This is all being accomplished with existing money. Okay. We didn't have to go out and get him another part-time job to afford this. We changed the flow of his existing money. And so you can see here his cash value jumping. This is his available cash value each year. He's going to keep paying this back. By the beginning of year 9, he'll be fully paid back. He'll be inside and outside, totally debt-free, and he'll have built up $96,000 in cash value. He can use it along the way. He doesn't have to not touch it. He had $45K here he can use for a real estate deal. He was trying to get into real estate investing. He had built up $72K here he can use. He's got $96K he can use here. That's a good rehab. I mean, that's a good, you can start, if you're in a small town, you can do the deal. But you can do the construction, a good construction side of a deal here. And I've got other good examples with fix and flips and stuff like that. But anyway, so he's gone from 30 years to 9 years debt free, built up cash. Now he's taken over the bank, he's replacing the bank. Plus it's life insurance. And we haven't even really talked about that. So he's got the death benefit and legacy, and there's living benefits to it. And he's got a way forward now. Okay. So let me talk about one last thing. I've been using the terminology borrow against your policy. So I just want to clarify that. Okay. So what does that look like? Okay. We'll say you here at the top, insurance carrier, and then bottom left is private family bank. So that's your cash value. So when you call the carrier, you say, hey, how much cash value can I borrow against? They're going to look at your policy, tell you have X amount. You say, great, I'll take a loan for X amount. So what they're going to do is they're going to loan you their pile of money, all the while your pile of money will sit and grow uninterrupted. Okay, so that's kind of what's going on behind the scenes. Now, because they're loaning you their money, they're going to charge you an interest rate. Right now, they have a fixed rate at 4%. But a lot of people get hung up on this. Wait. Why would I pay interest on my own money? Why would I pay them interest? Well, first of all, yours is growing uninterrupted throughout your entire life. The whole amount is compounding. The loan amount is 4%. So your compounding rate will outpace your loan rate over time. And you'll see that in your own illustrations. We can get offline and show you some illustrations and see how that works. But your growth inside your policy, remember the guy, he paid $12,000 in premiums, his cash value grew $36,000. So his 4% loan on the loan amount doesn't matter that much. Okay. So his growth is far outpacing his cost by then. So that's what's going on behind the scenes. I want to kind of wrap up with this quote. I love it. I love just the idea behind it, because a lot of people struggle with change. Like, how can I know I need to do something different, but how do I do something different? And I love this quote I heard once. He says, people change in 4 different seasons. He says, when they hurt enough that they have to, or when they see enough that they're inspired to, and when they learn enough they want to, or when they receive enough that they're able to. Anyway, so I would encourage you, if you're on this call, if you're hearing this recording, just don't be afraid to look into it. And even though some people just can't, they just struggle with, hey, I've never heard of this before, or sounds too good to be true, or whatever. Let's sit down, let's talk, let's dive into your situation and see what it looks like. I can be reached. I'm super easy to get a hold of. Shoot me a text, give me a call, shoot me an email, Scan this QR code if you want. You can schedule an appointment with me. I'd love to sit down and just talk through it. We'll dive deeper into this. I went super fast. I covered a ton of information and I didn't even cover all of it. And I get it, but that was the point of this call, was just to kind of give you a taste of it, what it is, what it can do, and let's dive into it. And again, I'll say it, change the way you think about your finances and it'll change your life, I promise. If you want to get a copy of the book, feel free to go to my website. It's 1024wealth.com/shop. You can scan the QR code to get you there too. And then if you type, when you're checking out for the printed copy of the book, if you put the discount code in there, Unbridled, it'll give you a few dollars off. And so get that book, read it. You can certainly go to the Nelson Nash Institute website. They sell it for 21 bucks also. And you can just buy it there as well. But I would encourage you to read that. So again, reach out to me. Let's talk. I'd love to just see what you and your situation is. So I'm going to stop here and let's if there's questions, feel free to type them in the chat. Feel free to unmute if you'd like and ask your questions. Yeah, one of the most common questions I get is how much is it to get started? And that's a great question. It's a valid question. And my answer is I don't know. The reason is because it's so catered, it's so individually catered to you and your situation. And we're going to sit down and we're going to talk. What are we trying to accomplish? First, it's education. Make sure you understand it. And then it's strategy planning. Let's dive into your situation. What's your capability, your financial situation look like? And what kind of ideas can we come up with? What kind of strategy can we come up with to implement? And it needs to be affordable for you. There's nothing worse than being insurance poor, stressing about writing that insurance check every month. So we don't want that for you. It needs to be affordable and attainable. And then as you get it, some people start small, and as they get it, they'll go out and get other policies later. That's exactly what I did. I mean, my very first policy, I think, was, I don't know, $400 a month or something like that. And I actually did it to recapture debt. I heard a guy talking on a podcast about it, and I called him and said, "Hey, show me this stuff. This sounds way too good to be true to get out of debt and build up cash value at the same time." So anyway, it's a customized approach. There's no how much is it to get started. There's really not an answer for that. We'll find something that works for you and your situation. Am I too old to get started is a good question. So sometimes that depends. The honest answer is sometimes. However, if you have family, so with policies like this, if you can get policies on spouses, you can get policies on kids, even grandkids. I've got a gal, she just got policies on 3 of her grandkids recently, and she is the policy owner because she's pushing 80. It's cost prohibitive to get coverage. And the growth, there's not time, right, to get enough growth in there. So she's getting them on her grandchildren. She will eventually give ownership of those policies over to them, but while she is the owner of the policy, she can control the cash value. And so that's a great strategy for people. Business partners, if you have business partners, they have insurable interest, so partners can own insurance on each other. Great question on what happens to cash value when one dies. So the cash value is actually a part of your death benefit. So when you borrow against a cash value, they're giving you access to a portion of your death benefit in the form of the cash value, in the form of loans. So let's say you have $1 million death benefit 1 year, and you had $200,000 in cash value, and you borrowed the $200,000 out, and you passed away the next day. They're going to subtract the $200,000 from the death benefit, from the million, and they'll pay the $800 difference to the beneficiary. And so it's also a good fallback, even for you if you have an outstanding policy loan. The death benefit always is far higher than the cash value, so you can't get upside down. So you'll recapture that. They'll recapture that via the death benefit upon death. Great question. All right, guys. Well, you've got my contact information. We'd love to sit down and chat if you want. Feel free to reach out. And I'm going to wrap this call up. Thanks for taking the time tonight. Hope you learned something, and we will talk to you guys soon.